Now let's talk about the dark side of cryptocurrencies. Because of the instant growth of Bitcoin price, a lot of people saw the opportunities and they invented a lot of cryptocurrencies similar to Bitcoin, either use a blockchain technology or just run a Ponzi scheme without blockchain technology. By July 2018, there are 1,800 cryptocurrencies around the world, and the total capitalization is about $300 billion, which is not a lot because if you look at a stock like Apple, the market capitalization is $1 trillion, and at that time, even though there are thousands of cryptocurrencies, but they each, on average, does not have so much buyers or money put into it. Another noticeable feature of Bitcoin is the anonymous feature. Because if you use Bitcoin, people cannot know your identification directly. They only get your a passcode and an address. So that's not enough to identify you in the blockchain system. So that makes Bitcoin a perfect transaction currency for illegal activities because that anonymous feature helps the Bitcoin users escape government monitor. And about $76 billion of illegal activities per year involve Bitcoin transactions, and that's nearly half of the Bitcoin transactions. And uh, a lot of these transactions are closely related to illegal drugs. And if people use Bitcoin, they don't use Bitcoin on the clear net. They use Bitcoin in the dark net. So, what is the definition of a dark net? So, if you look at our internet system, you will see a clear net where you can search things through search engines like Google, Bing, Facebook, and so on. So, there are a lot of public information on the clear net which is searchable. And there's also deep web. It's also part of the internet, but you cannot get it unless you put in your credentials like password. It's like your transcript. Your transcript is online, but not everybody could get it unless you give them your passcode and all the identification information. And darknet is at the very deep part of the internet. You cannot hide, you cannot find them by using search engine. You can only type in their addresses and use a specific explorer to get access to it. And so some examples of a darknet are put into this picture. I'm not going deeper to that because I don't want to teach you the back things, but I just let you know on the darknet there are a lot of illegal activities like prostitution, drug dealing, human trafficking, a lot of nasty things going on there, and the Bitcoin is a big has a big involvement in darknet. Now, if you are a legitimate investor, you can still consider cryptocurrencies as a investment vehicle because it is indeed a financial asset. Why do we want to incorporate cryptocurrencies into our portfolio of investments? Despite that, a lot of cryptocurrencies are Ponzi scams because many of the cryptocurrencies have a high return on average, and it also has a low correlation with other financial assets. So if a cryptocurrency has low correlation with other assets, that makes it a very good tool for hedging the overall risk of your portfolio. If you put a Bitcoin in your portfolio, then the overall risk of the portfolio could be reduced. Regarding to diversification of portfolio risk, we're gonna have a specific chapter for that. It's a chapter 8 and chapter 9, and there's an Excel project designed for that. But for now, you should know that if we incorporate an asset into our portfolio, and that asset like Bitcoin has a very low correlation or even negative correlation with other component assets, then your overall risk could be reduced. And also Bitcoin, the volatility of Bitcoin, the trend of Bitcoin is against the global financial crisis. So when the world financial market is good, Bitcoin may not act as good. But if a global market is bad, then Bitcoin may actually have a increase. So that basically is a good feature for a diversifying assets. And here is the formula to determine the Bitcoin price. Just like any other commodities or securities, the price of it is depending on the supply and demand of it. So here I put the formulas. You probably have learned these formulas in your money and banking classes. So I'm not going to go into detail to that, and I will not give you test questions for based on these formulas. All I need to say here is that you should know there is a certain way to determine the Bitcoin price based on the supplies and demand. Okay, and the funny thing about Bitcoin is the macroeconomic factors. They do not affect Bitcoin prices. So if the global market is running well or running bad, the Bitcoin price is just unaffected. As I said, it makes a good tool for diversifying the overall risk of your investment. What would make Bitcoin price change is the uncertainty about economic policies. You see, it's not about the economy is going up, it's not about the economy is going down, it's about the uncertainty. We don't know whether the economy is going up or down. So that uncertainty could affect Bitcoin price negatively. And this has been empirically tested. So there's evidence suggesting that. And talking about Bitcoin trading, there are a lot of informed traders of Bitcoin. As I mentioned earlier, a lot of Bitcoins are owned by the original Bitcoin miners and institutional investors who hold large ownership of Bitcoin. And they also have a lot of resources to launch propaganda to boost up the Bitcoin price through pump and dump schemes. And they know what will happen regarding to Bitcoin. So we call them informed traders because they build their positions before the event happened. So a research says that the informed traders prefer to buy a lot of Bitcoins just 2 days before large positive events. So when the positive events happen, then Bitcoin price will go up. The informed traders would make a fortune. And the informed traders could also sell their positions 1 day before large negative events in order to prevent losses. So they always on the top of the game, and they harvest the money from uninformed traders. And if we look at Bitcoin ownership again, 2% of Bitcoin accounts control 95% of all Bitcoin, and that is sick. That is very sick for a healthy investment or any assets people own. And so the 2% account, so they could be, they are just manipulators, just like back in the 90s, there are a lot of manipulators on the Wall Street. They promote pump and dump schemes, and they have a large control of the securities, so they can boost up the security prices very easily, and they could um, make others, retail investors, to follow them and profit from their innocence and lack of knowledge. So if you are an investor, not just for Bitcoin, but for any kind of securities, you should watch for the signs of manipulative trading because you are always at the bad end of the deal unless you are a manipulator. So what are the manipulative trading? The signs? One is that the ownership is quite concentrated. Okay, like Bitcoin, 2% owns 95% of Bitcoin. And also, the volatility is very high. For all the manipulators, they want to make the price goes sharply up and down. That's called a high volatility. So when it goes down, they can buy. When it goes up, they can sell. That's how they make a fortune. And for the manipulative trading, the movement of the prices are affected by the manipulators. Whenever they want to boost up the price, whenever they want to dump their shares, it's less affected by the market. And also, the economic factors has low connection with these cryptocurrencies or any manipulative assets we are talking about here. And also large trades make money. And that is a big sign of manipulative trading because large trades are usually conducted by the controllers, the manipulators, or the informed traders. Um, and of course, for manipulative trading, there are a lot of advertisement and news. I wouldn't call them authentic because they are more like a propaganda launched by the manipulators who has a lot of shares and a lot of resources. They just want to draw more and more potential buyers. It's like running a Ponzi scheme. They want to attract more people's money in order to pay off themselves and the first group of investors.